When you first start to invest, it's incredibly difficult because there are thousands of funds to choose from. And where do you begin? Well, it's useful to have a template from which you can draw inspiration. So in this video, we'll look at some of those templates. You can look at Robo funds, but you can also back out simple versions of things like LifeStrategy funds to get you started. And then you can take those weights as a starting point and make adjustments according to your risk appetite and also your beliefs about which returns are going to be best. So let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. A question many people ask me once they've got their platform set up is, where do I start with my DIY portfolio? Whatever you do, I suggest you use these 3 guiding principles. Firstly, keep it simple. Don't try and have hundreds of different funds in the same portfolio. Now that you can buy a single fund that tracks entire markets, it's possible to diversify with very few funds. And remember that you should diversify. Don't just buy one stock or one asset type. Buy stocks from different regions and buy different asset types. That way you reduce the risk of your overall portfolio. And if one market crashes, you haven't put all of your eggs into one basket. And perhaps most importantly, choose funds which have low fees, because the ongoing fees are guaranteed to lose you money every year, forever, and fees compound over time just like returns. Another thing to bear in mind before you start is your appetite and your capacity for risk. If we go from low risk on the left to high risk on the right, a low risk portfolio contains more bonds, and a high risk portfolio contains more equity. And the period of time for which you're investing also affects this decision. Generally, if you need the money in a short period of time, you don't want to take a huge amount of risk. But if you're investing over a very long period, then you can afford to take more equity risk. And if you've watched my video on Vanguard life strategies, you can see that those funds are graded in exactly this way, with the investment horizon stretching from short term, 3 to 5 years, up to longer term, which is greater than 10 years, and with a 20% equity fund slotting into the low risk bucket. Then we gradually dial up the risk and the amount of equity until finally we have 100% equity, which has the highest risk. BlackRock has a similar suite of products called consensus funds, which go from the very safe Consensus 35 fund all the way up to the Consensus 100 fund, which has the highest risk. And in 2019, BlackRock launched the MyMap family of funds, which are risk graded in exactly this way, ranging from MyMap 3, which is the lowest risk, all the way down to MyMap 6, which is the highest risk. If we drill into the LifeStrategy funds, you can actually look at the individual allocations for every fund. LifeStrategy funds are just funds of funds. They contain other funds inside them. So Vanguard's LifeStrategy 20% contains about 20% of this global bond. And as we increase the amount of equity, we dial down the bond allocation, until for 100% equity, there's no bond allocation at all. But notice that even the 100% equity allocation is regionally diversified. It's not just in one country, although the US does dominate at 44%. Here's the same information as a graph, and you can see the equity dialing up as we increase the risk, and at the same time, we dial down the bond allocation. Now, if you don't want to go down that route of just one fund, which could be a LifeStrategy fund, a MyMap fund, or a consensus fund, there's a very simple alternative, which is to have a 2-fund portfolio. And I've done a whole video about that. But if you want something with a bit more finesse in terms of regional allocations, then one way to get inspiration is to look at Robo funds. So for example, Nutmeg publishes these fixed allocation portfolios, and you can see the individual ETF allocations for that portfolio. This is the breakdown of their equity component. And other Robo funds do the same thing. Here's an equivalent page for Money Farm, and this is the allocation for the medium risk portfolio, which has the number 4. So if you want inspiration for your portfolio, you could just take these allocations and map them roughly to the funds which are available on your platform. And preferably you choose the funds which have the lowest fees. To give an example of that to get you started, what I've done here is to take Vanguard LifeStrategy funds, but I've simplified them, reducing the number of funds. Because LifeStrategy's fee is 0.22% per year, I've only chosen funds which have a fee which is lower than that, because we may as well reduce our fee if we're going to make our lives more complicated. I've also chosen funds which have existed before 2017. That gives me a bit more price data to play around with in the next step, which is that I try to match the returns from LifeStrategy as closely as possible with this reduced set of funds. I found that you can match the returns fairly well using just 5 funds. The fund names are listed here, and the allocation for LifeStrategy 100 is here. You can see that it uses just 2 funds. Vanguard's Developed World X UK fund, which makes up about 70% of this portfolio, and the Vanguard FTSE All Share Tracker, which makes up the rest of the portfolio. Then as we go to LifeStrategy 80, the amount of equity falls, as you'd expect. So the Developed World X UK equity falls to 52%. And now we start to see some of these bond funds, the UK Short-Term Investment Grade Bond Fund. And then as we get to LifeStrategy 20, the Global Bond Fund dominates the portfolio, as do UK corporate bonds. So you can see the fees of the funds I chose are very low, with the largest being 0.15% per year, and the smallest being 0.08% per year. Let's see how closely the returns match those of the LifeStrategy funds. You can see it's not perfect. The blue line is LifeStrategy, and the red line is the approximation using just 5 funds. But considering the simplicity of these portfolios, they do a pretty good job. And you don't have to use Vanguard funds to match those returns. You can also use iShares funds. BlackRock has a great idea with its iShares funds, which is to simplify them down to the core funds that you need to build a portfolio. Although they have over 100 funds, the core is only about 30 funds. And it turns out these 6 funds can produce those LifeStrategy returns fairly closely over the period since 2014. So for the LifeStrategy 100 fund, you'd need about 40% of the iShares S&P 500 tracker CSPX, and about 24% of the UK FTSE 100 tracker, and so on. And as you dial down the risk, you dial up the amount of the bond fund, which in this case is just IGLT. Notice that some of these funds are a bit cheaper than the ones from Vanguard at 0.07% per year, and the tracking was also a bit more ropey, particularly for the LifeStrategy 20 fund, and that's probably because the portfolio doesn't contain a global bond fund. So here are the costs for the Vanguard simplified portfolios, which range from about 0.15% for LifeStrategy 20% down to about 0.13% for LifeStrategy 100. The iShares portfolios were a bit cheaper, which is because the funds were cheaper. Now remember, for these simplified funds, you're going to have to rebalance the portfolio yourself. So if the equity component rallies a lot, say, you'd have to sell some equity and buy some more bonds. And that's to keep your allocation in line with your long-term goals. And that's why for most people, it's much easier just to buy a simple fund like LifeStrategy and get all of the rebalancing done for you for 0.22% per year. So remember, the purpose of this video was to give you inspiration. It wasn't to copy those portfolios. And there's no guarantee that those portfolios would continue tracking LifeStrategy in the future. But if you want a bit more flexibility than is offered by just having a single multi-asset fund, maybe because you don't like one of their regional weights, or you want more of a particular country to be added to your portfolio, then going down this DIY route gives you that extra flexibility. And it should end up costing you a little bit less. So whatever you do, don't copy those weights exactly. Use those as a starting point and adjust them to your particular needs. Now, if you do find these videos useful, please do subscribe to us on Patreon. We don't have any support other than you. So if you do support us, it's just $5 a month. That turns into £5 if you add VAT and convert it to sterling. And if you support us at the $15 a month level, you get a one-to-one session with me every other month. Now, if you do subscribe, you also get access to our Slack channel, so you can chat to the other members of the community. And you also get to join our Sunday evening call, where we would love to see you. And as always, thank you for listening.